think it's while we wait for that, it's important to visualize what inflation volatility looks like, right? This is a series of papers that man has put out, but this particular paper goes back to 1926 and helps us visualize what CPI volatility has looked like for over a century. And what's obvious here is how lucky we've been in the last 20 years to be in a period of such benign inflation that tends to be good for a number of things, right? It tends to be good for planning. It tends to be good for business building, and equity markets tend to thrive in that type of environment. When you have a bit more uncertainty, and by the way, you can have a more and more narrow market that way. When you have a bit more uncertainty, there's going to be more dislocations across the landscape of investments. But I thought it was useful to share this chart for everybody.
Yeah,
Well, yeah, but
it just to highlight it a little bit more, from 1990 to today, we've experienced inflation volatility of like around 1.3%. If you go back prior to 1990 into the late 1800s, so the previous sort of 100 years, you had inflation volatility that ran around 4.8%. Remember, this is inflation volatility, as Adam laid out. This swing from, it's disinflationary, it's inflationary. These things were happening much more regularly and had significant impacts on asset prices. Where from 1990, we've had a fairly stable state of disinflation, which leads to certain asset classes like stocks, for example, or real estate, really having some pretty pronounced returns and at low volatilities. And so as we potentially move into a regime that has more inflation, and I think we can all sort of concede that, well, certainly inflation volatility, whether this is transitory or not, the volatility of inflation has increased. And thus that is an era that's new. And that's a key concept here that I think is maybe not as understood as it could be, because it's new. It hasn't happened in 30 years. And so we have a whole suite of investors, portfolio managers, allocators who have had an experience in their careers lasting, 20 to 30 years, that is purely one environment. And so it takes some time for that Overton window to pass through acceptance and sort of accepting a new reality, potentially, if that's the case. So just to give some more highlights on what, how that chart was sort of representing the information.
What was the poll question there? So we got 2/3 that it said one.
Yeah, that they're more in the inflationary sustainable camp, and a couple about a third are in the more transitory camp. So that's great. Mm-hmm. I think that
it's all about the other thing as always is what do you mean by that, Mike? Like, I think it's persistent, and for me persistence means 12 months out, right? Are we thinking 5 years out? Are we thinking, maybe the people that think it's transitory, it is 12 months to 18 months. That's a lot of time for that we can have runaway inflation for, and a lot of opportunities to make money.
Well, like you said, is it the 40s where we've got this burst and we're going to now have a new equilibrium, but it's going to settle down? Or is it this, persistent sort of 70s scenario where here's this type of inflation, and then here's another type, and here's some more inflation for you, and by the way, the central banks are going to get involved and they're going to constrain liquidity in order to fight the inflation. Again, this comes back to inflation volatility versus just inflation.
Yeah,
and that's I think it's hard to argue that inflation volatility is not upon us. That I think we could categorically say the evidence points to, yes, that's here. And maybe it settles down. Maybe it's the 40s and we get, another 5 or 10 years where it attenuates. I don't know. But you want to think about how to prepare portfolios for that, and how those dynamics like growth and inflation, which we talk about a lot. We have our market target. We talk about those asset classes that perform well. Maybe it's time to pop that chart up.
That's
to
exactly what I'm doing,
Rod. And observe that, so we've got to now take real steps in portfolios to prepare for a slightly different regime than we've had previously. And maybe it's significantly different. And maybe, Rod, you want to walk through this stuff?
Yeah.